I'm John Batchelor. There's trouble in China. Gordon Chang of Forbes.com joins me, and Thaddeus McCotter, my colleague and co-host from WJR, the great voice of the Great Lakes. We begin the new year with very, very worrisome news because the path ahead is not clear. It's foggy. There are many trails that go in many directions. The disconnect between China's tumbling markets and unclear real estate, that disconnect is no longer. We can see with the reaction in Europe and the reaction in the United States today in the markets, plunging. No one was counting on plunging 1.5% for the opening day of trading, that there is anxiety. And the anxiety is not fixed. So we welcome Gordon to explain why now, why this, why the plunge. Gordon, a very good evening to you. The Chinese stock market is gamblers' territory. And we watched it last summer plunge and rise in the intervention, and they forbid short trading. This is the Communist Party forbids short trading, and then they pushed a lot of cash in and they bought stocks at the end of the day. A lot of game playing. We got used to it. We actually stopped talking about the story for several months in the fall. And now it's back suddenly. What's different this time? Is it different this time? Or did Rip Van Winkle wake up out there, and that's why the anxiety? Good evening to you, Gordon.
Good evening, John and Thaddeus. It is different this time. Today, which is the first day of trading in 2016, China hit its circuit breaker, which suspended trading in the afternoon. These are new rules that went into effect today, and coincidentally, they kicked in for the first time today, and they're very poorly designed. What happened is, essentially, the Shanghai market fell almost 7%, and Shenzhen fell a little bit more, 8-point-something%. This was stunning, took everybody by surprise, but it probably shouldn't if we had thought about it. What happened is the market Purchasing Managers Index, conducted by the private research firm Market, came in with a very bad number for the Chinese manufacturing sector. Also, at the end of this week, on Friday, the lockup period for institutions expires, which means that large Chinese shareholders can, for the first time in 6 months, sell their shares in the open market. And investors were worried that they would do so and drive prices down. So these two factors contributed to a very, very bad day in China. That created problems in the Asian markets. It rippled through Europe as it normally does. And at the opening in New York, the Dow fell 300 points, largely because of concerns about China.
Thaddeus?
Gordon, as some of the steps that the communist regime took to prop up the stock market have failed, what are the steps they're even considering to do now? Well,
we really don't know, but I guess we can sort of figure it out. First thing is they're probably going to extend the lockup period, which would otherwise expire on Friday. Because if they don't do that, there will be massive selling pressure on the last day of this week. Also, we can expect that the government will be in the market, either directly or through institutions, buying shares. Now, the Chinese markets have been open for a couple of minutes, and it appears that there was big government buying, which drove prices up in Shanghai a little bit, but nonetheless, it's pretty clear that without the government intervention, markets would have opened much lower. In Shenzhen, in the first few minutes, prices are down, and that's a little bit extraordinary because I would have thought government would be buying in Shenzhen as well. We will know a lot more by noon when the markets are basically closed for the morning session.
Gordon, is it accurate that the stock market in China is not an investor's place, it's a gambler's place? And does this connect in some fashion to the softness of the economy? Is that what's being expressed, or is this entirely having to do with the government intervention?
Yeah, this is the softness in the economy. That is, the Purchasing Managers Index was the thing that triggered the fall today. I think that essentially Chinese investors, like most people in China, are very concerned about the downward direction of the economy. They've seen that government measures over the last 14 months have failed to change the downward direction. And so people are trying to get their money out. And one of the things that we saw in the third quarter was money gushing out of China at a very fast pace, unprecedented. And so I think that right now there is deep pessimism, a loss of confidence, and Chinese leaders are trying to struggle to keep stock prices up, and they can succeed for a month or two, but long term, no government is able to prevail over a market, especially as one as big as China's.
Thaddeus?
Yes, Gordon, I think as it's been mentioned, it's a gambler's place, it's not an investor's place. So what happens then when the government ultimately, as it's going to have to do, stops propping up this market? What investor wants to be caught in that scenario when the prices go right back down again?
No investor wants to, and we saw that today. These circuit breaker rules, these are rules meant to stop trading after big increases or big falls. These circuit breaker rules actually contributed to the panic because people saw the direction of the market early in the morning, and then they decided to bail. And that is a big sign of a lack of confidence. And there are other factors that contributed to this. But I think the story here is that people both in China and outside China are seeing that the measures that the Chinese government has taken to prop up share prices aren't working. Like these circuit breaker rules are ill-conceived and actually contributed to today's rout.
Back to the Chinese economy underneath, Gordon. There's been no surprising development. That's what I'm looking for. Manufacturing, import, export, money supply, the renminbi, nothing sharply departing. It has been in decline for some time, and that's still the case. Is that all correct?
That's all correct. I mean, people who have been looking at the Chinese economy closely probably weren't surprised by the very bad Purchasing Managers Index number that was released today. I mean, it showed 10 months of straight contraction in the manufacturing sector, but everybody knew that. It's just one of those tipping points, John. I think that essentially people are starting to say, oh my God, this is really bad. And so therefore you have just an overnight change of sentiment. And when those things occur, it's very difficult for governments to employ measures to stop a market from falling. So as I said, they can sort of arrest the decline, but they can't really do anything long term. And by the way, John, the currency is also falling at the same time.
Yes, it's very low. The currency is extremely low for what it's been over the last 10 years.
Yes, and there's the problem for China right now is that there's a big offshore market for the renminbi as well as the onshore market. Now, the disparity in values between onshore and offshore is getting larger and larger, and that means China's in trouble because people are now doing arbitrage trades, and that is sort of undermining the government's ability to control the currency's value. This currency is going to fall very fast at some point, John, and people right now are starting to think about what the bottom for the currency is, and the numbers that people are estimating are much worse than they were 2 months ago.
Thaddeus?
Gordon, you've talked about it before, that with a lot of the phony economic numbers that come out of this regime, it has very little credibility to buoy investor confidence in any report, even if it is accurate. But what about the credibility of the regime with a falling economy, a falling stock market? How long does this regime continue to pretend that it is actually capable of governing?
Well, I think that's a great question, Thaddeus, and I don't have an answer to it, but I think the general view, or at least my view, is that they will continue to intervene until they no longer have the ability to do so. And when they no longer have that ability, the markets, both share markets and currency, are going to fall unimpeded. And that really means a 1929-style crash in both your economy and your currency. And this probably will be an historic event that not only we will remember, but our children and grandchildren. This is like a 1930s Great Depression-style event, which we are very close to.
Detail. One way to distract everybody from a tumbling renminbi and a crashing market is foreign policy adventurism. I note, Gordon, and you and I have discussed this, that there was a news report in the Wall Street Journal within these last hours of China landing a test flight on one of the phony islands, the artificial islands in the Spratlys. It's a test flight. It's on a newly completed airfield. Does this indicate that China is going to become more aggressive in the Spratlys? I note that Vietnam protested immediately.
Yeah, what happened is on Fiery Cross Reef, which is one of these reclamations, the Chinese landed a civilian craft to test the runway, and Vietnam immediately protested it, and I think the Filipinos have done the same thing. Now, this is a runway which is much, much longer than would be needed for civilian craft. This is a military-style length runway, and nobody wants anything to happen there. But of course, once China built the runway, they were going to test it. So I don't think, this has attracted news. I don't think it's significant, though, because everyone knew this was going to happen anyway. But, the larger narrative of what you said, John, is absolutely right, that China is pushing out on its borders, not only in the South China Sea and elsewhere. And there's problems we see in the economy and in the markets. They're going to try to bolster their legitimacy with hostile actions against their neighbors and against the United States.
Thaddeus?
Yes, but Gordon, that's a very short-sighted strategy that ultimately is doomed to failure, because two of the greatest economic powers that they need to help them and interact with them on a commercial level are the United States and India, neither one of which is going to look kindly upon this adventurism for the sake of the Chinese Communist regime's domestic consumption.
Right, and also you can add into the mix Japan, which is the world's third largest economy. I mean, Japan's companies have been reorienting their foreign investment away from China and towards India and Southeast Asia. And part of that is because the economy in China is bad, but a large part of it is because of the anti-Japan sentiment that Beijing has purposefully stirred up. And so this is important for China, that they are not getting investment dollars that they need for their economy right now. They desperately need it because they have massive capital outflow, and they need foreign direct investment to help compensate for that. Well, they're not getting as much of it because of their hostile foreign policies. So we see that both foreign policies and economic policies are creating this spiral downwards, and Chinese leaders have obviously lost the playbook.
Gordon Chang, Forbes.com, and Thaddeus McCotter, WJR, noting here at the end that the Hang Seng and the Shanghai are both showing essentially unchanged, a little bit on either side of the start. So whatever's going to happen will happen later in the morning, Hong Kong time. I'm John Batchelor. This is The John Batchelor Show.